Welcome to Accounting with Professor Lamptey. Today we are going to explain the balance sheet. If you are studying for an accounting test, preparing for the CPA exam, or trying to understand financial statements for the first time, the balance sheet is one of the most important statements you must master. Why? Because the income statement tells us whether the business made a profit or a loss. The statement of owner's equity tells us how the owner's claim changed. But the balance sheet answers a different question. The balance sheet answers three key questions. What does the business own? What does the business owe? And what belongs to the owner? Those three questions are answered at a specific point in time. That is the power of the balance sheet. It shows the financial position of the business, not performance over a period, but a snapshot on one date. So today, we will break this down in a simple way. We will explain assets, we will explain liabilities, we will explain owner's equity, we will look at the accounting equation, we will build a complete balance sheet example, and then we will connect the balance sheet to the income statement, the statement of owner's equity, and the accounting cycle. Let's begin. The balance sheet is a financial statement that reports a company's assets, liabilities, and owner's equity at a specific date. The key phrase is at a specific date, or on the statement itself, you will usually see the words as of. For example, as of December 31st, 2026. That wording matters. The income statement says for the month ended. The statement of owner's equity also says for the month ended, but the balance sheet says as of December 31st, 2026. Why? Because the balance sheet is not measuring activity over time. It is showing the financial position of the business on one date. Think of it like taking a picture. If you take a picture today, that picture shows what things looked like at that moment. That is what the balance sheet does. Now, the balance sheet is built on the fundamental accounting equation. Assets equal liabilities plus owner's equity. This equation is not just something students memorize for an exam. It is the foundation of the balance sheet. First, assets. Assets are resources owned or controlled by the business that are expected to provide future benefits. In simple terms, assets are what the business has. Examples include cash, accounts receivable, supplies, inventory, prepaid expenses, equipment, buildings, and land. Assets are usually listed in order of liquidity. Liquidity means how quickly an asset can be converted into cash or used up. Cash is usually listed first because it is already cash. Accounts receivable comes next because customers are expected to pay. Supplies, inventory, and prepaid expenses may follow. Then long-term assets such as equipment, buildings, and land come later. Now the second section is liabilities. Liabilities are obligations the business owes to outsiders. In simple terms, liabilities are what the business owes. Examples include accounts payable, notes payable, salaries payable, interest payable, taxes payable, and unearned revenue. And unearned revenue means the business received cash from a customer before earning the revenue. This is very important. Unearned revenue is a liability, not revenue. Why? Because the business still owes goods or services to the customer. The cash has been received, but the revenue has not yet been earned. Now the third section is owner's equity. Owner's equity represents the owner's claim in the business. It is what belongs to the owner after liabilities are subtracted from assets. In a sole proprietorship, we usually call this owner's capital. In a corporation, the equity section may include common stock and retained earnings. But for this beginner lesson, we will focus on owner's capital. Owner's equity increases when the owner invests in the business. Owner's equity also increases when the business earns net income. Owner's equity decreases when the business has a net loss. Owner's equity also decreases when the owner withdraws cash or other assets for personal use. But remember this key point. Withdrawals are not expenses. They reduce owner's equity directly. Now here is the connection from the previous video. The ending capital from the statement of owner's equity flows directly into the balance sheet. So if Lamptey Consulting's statement of owner's equity shows ending capital of $32,300, that $32,300 becomes owner's capital on the balance sheet. This is why the financial statements are prepared in order. Income statement first, statement of owner's equity second, balance sheet third. The income statement gives us net income or net loss. The statement of owner's equity uses net income or net loss to calculate ending capital. The balance sheet uses ending capital to complete the equity section. Now, let's build a simple balance sheet. Assume Lamptey Consulting has the following balances on December 31st, 2026. Cash, $12,000. Accounts receivable, $8,000. Supplies, $2,000. Equipment, $20,000. Accounts payable, $6,000. Notes payable, $3,700. Owner's capital, $32,300. Now let's organize this properly. The heading should show Lamptey Consulting, balance sheet, as of December 31st, 2026. Notice the wording, as of, not for the month ended. The balance sheet is prepared as of a specific date. Now we list assets first. Cash, $12,000. Accounts receivable, $8,000. Supplies, $2,000. Equipment, $20,000. Now we total the assets. $12,000 plus $8,000 plus $2,000 plus $20,000 equals $42,000. So total assets are $42,000. Next, we list liabilities. Accounts payable, $6,000. Notes payable, $3,700. Total liabilities are $9,700. Then we list owner's equity. Owner's capital, $32,300. Now we add liabilities and owner's equity. $9,700 plus $32,300 equals $42,000. Now, if the balance sheet does not balance, something is wrong. It may mean an account was omitted. It may mean a number was entered incorrectly. It may mean an account was placed in the wrong section. Or it may mean ending capital was not transferred correctly from the statement of owner's equity. So when preparing the balance sheet, always check the equation. Assets equal liabilities plus owner's equity. Now let's summarize. The balance sheet reports assets, liabilities, and owner's equity at a specific date. Assets are what the business owns or controls. Liabilities are what the business owes. Owner's equity is the owner's claim in the business. The balance sheet is based on the accounting equation. Assets equal liabilities plus owner's equity. It is called a balance sheet because both sides must balance. So when you look at a balance sheet, always ask 3 simple questions. What does the business own? What does the business owe? And what belongs to the owner? That is the balance sheet. If this lesson helped you, subscribe to Accounting with Professor Lamptey, hit the like button, and leave a comment with the accounting topic that confuses you the most. In the next video, we will explain the statement of cash flows and show why profit is not the same as cash. We are breaking down accounting concepts, simple, clear, and accurate.